Hi everyone, I think we'll give a couple of minutes more and then we can get started. All right, I think it's 10 past 6, so probably we can get started. We have a good number of participants. Good evening, everyone. If you could all chat with me in the webinar chat, and if there's any questions, I can take there. So I need everyone to be engaged, and if you could all start saying good evening. It's a good Saturday evening for all of us. All right, so we'll get started now. So welcome to this fascinating and very dynamic world of finance and accounting. This is a space where the income statement meets balance sheet, the assets meets liabilities, the project meets funding, and the goals meets the required motivation that is required to achieve it. Today, for the next 1.5 hour, we'll talk about how earnings management meets its impact on valuation. I'm very thrilled to have all of you in this masterclass. I'm Praveen Salian, and finance and accounting is my core expertise and interest. I have worked for almost 19 years and now looking to learn through teaching, and that's my passion as well. Been in companies like Datamatics, WNS Global Services, RSM McGladrey, and a major part in JP Morgan Chase for almost 13 years. So that's my 19 years in finance and accounting, various roles in operations, in teaching, and project management. So try to bring all that expertise today and over the next 1.5 hour that we would be spending together here, and I get to learn from all of you. Just give me a minute. All right. Yeah, people are saying good evening to everyone. Almost 71 people have joined. That's a good number. I'll just wait till the chat rests with all the wishes. And I hope you're able to see my screen. And I'm good, Hemani. I hope all of you are good as well. And I hope I'm very audible to everyone. All right, great. Let's get going then. So we will cover the main subject today is the earnings management and its impact on valuation. So earnings means income statement and valuation means balance sheet. The relation between these two is what we are going to cover for today. And we will cover it in 4 parts. First, we'll understand what's earnings and what's managing earnings means, what's the impact on the financial statements, how valuation happens, and what are the ethical considerations and what are the future trends. All right, so let's get started with understanding earnings management. So what do you understand by earnings, everyone? I need inputs from all. What do you understand by earnings? Just by word earnings, not too technical. Profitability, okay. Sales, okay, that's revenues. Any more? Profit, yeah. My voice is slow, okay. I will try to speak as loudly as possible, but maybe you can also try to increase the volume at your end. Yield, profits, services, income from services, yeah. Returns, net gross income, salary is earnings as well. So absolutely. So sales minus purchases, the difference is profit. You get passive income, interest income, rental income, salary income. All these are revenue. You're absolutely correct. Now, what is earnings management means? Now, we understood what is earnings. What is earnings management? And this session over the next 1.5 hours, I'm going to learn from all of you. It's not you learning from me. I'm going to learn from all of you. So what is earnings management? Just by English word earnings management. You manage our income properly, okay? Managing sources of revenue, fine, good. Managing all the income, managing our income, excellent. The process of forecasting, good. How much would be my income? How do I manage that? Controlling cost, sales, yes. You are already through. Reinvesting the returns, yes. Reinvesting the returns so that you get a better return in future. Genius, you're already genius. Diversification of earnings, okay. So it's mainly diversification of investments, if I would change that word, so that in case of any risk, it gets mitigated. One option gets mitigated by other. Distribution of income from certain assets, yes. Using income in the best way to earn more, right? So I'll give you an example now. And this is an individual household example. Say I have a apartment and I let out the apartment, and with an agreement with my tenant that he needs to pay me 2 years worth of rent in advance. So I'm letting out my apartment for 2 years, 15,000 per month. So it's like 180 in a year, or for 2 years, it's 360. So my tenant pays me 360,000 today for me to let out my apartment to him. So is this 360,000, which I've already received, it's already in my bank, can I say that this is my income? You all got my question, right? Keshav is saying no, Ishav is saying no. Anyone else? Kasim is saying yes. Few no's, few yes. I repeat my question. I have let out my apartment with an agreement that my tenant will pay me 2 years worth of rent in advance. So 15,000 per month, 2 years, 360,000 I've got upfront. Even before I hand over the key. Is this 360,000 today my income? People are saying no. Majority of people are saying no. Why no? Advance received, right? So income revenue is on behalf of providing services. I'm not sure. I'm letting out my apartment. It's not service. It's kind of advance, correct? It's not deposit. It's a rent that I received in advance, not yet accrued, right? Deferred income, correct? Absolutely. So this is an advance that I'm getting for next 2 years. So I am going to earn this money, although this money is already with me. I'm going to earn. I've not earned it today. I've only got the money in advance. I can use it, but I've not earned it. I'm going to earn it over the period of time. So over the next 2 years. So by end of this year, I can at the most say I have earned 1,80,000. I still need to keep another 1,18,000 prepaid. In finance term, this is what we term it as earnings management. I can't report today that I have already earned 360 because I have not. If tomorrow, if I need to, for whatever reason, I need to give the notice and request my tenant to move out, then I will have to refund because I've not earned it. So until and unless the product or the service has not been provided and the collectibility is not probable, I cannot say that I've earned a revenue. So that's earnings management. Now, it can be absolutely in a ethical way as well when I report a revenue, but at the same time, when it comes to real business, I need to be very careful as to what is my income. Now, coming to earnings, would you all agree with me that everyone wants to show a big picture of earnings? Yes. I mean, someone is saying no, Varun is saying no. I mean, no, unless you are meeting an income tax guy. So, apart from the income tax guy, I believe everyone wants to. I can't hear you properly. I think Pranjal is not able to hear me properly. Others, are you able to hear me properly, or is it only Pranjal's issue? Am I audible to everyone? Okay, so Pranjal, can you see if the volume at your end is good? Oh, great. I'm audible. So, how many of you are working and as compared to students? Everyone are working in office, in a finance and accounting department, or in sales department, or in any other? Okay, someone says I'm working in market risk. I'm a student. Okay, so I think we have a fair balance between students and working. Now, if someone is in sales department, would you have a motivation to show up your sales as much as possible? Yes. Now, if the statement is there are two statements. One, I'm saying I've worked for X number of hours. And second, I'm making a statement that I've sold 10 products. Statement one is good or statement two is good? Which one your stakeholders would like to hear? Statement two. So irrespective of how many hours I'm working, what's important is how much products I'm selling. So if someone is in finance and accounting, irrespective of how many number of hours I'm putting in, what I would like to present is how many month-end close I've worked, how many financial statements I've prepared, how many reports I've delivered, what is my accuracy. These are my performance metrics which I want to showcase. Yes. If someone is in sales book, you want to showcase how many sales you have marketed and why so. Your bonus will be based on that sales. So you will have a motivation to result into as many sales as possible so that you earn as much big bonus as possible. So would you agree that every company will have a motivation to show as much big earnings as possible? And by doing so, will they also have motivation to or inclination to show sales a little bit more than actual? Or in case of finance and accounting, if I'm saying I have completed 5 projects, whereas the 6th project is just 1 week away from implementing, will I have that inclination to show that one which will be completed in the next month today itself? Sales number difficult to manipulate, okay? But will I have that inclination? If it's easy to manipulate, will I have inclination to show sales number as much as possible? Yes. So that's the manipulation that we are talking about. There are some ethical manipulations, some are unethical manipulation. So if the revenues has not been earned, if the sales has not been earned, then it's unethical to show it. But there is a ethical way of showing it as well. For example, in sales department, I have not met my target at the end of the year. So I am giving discounts so that the sales increases in the last month and I achieve the sales. Is this an ethical way of increasing the sales in the last month so that I meet the target? Yes, very ethical. Or in case of more in finance world, bill and hold arrangement, in the sense that I have sold the goods, but my customer is saying just hold the product. I'm billing him, I've already sold this product, but the customer is saying just hold it because he doesn't have enough space, for example, enough space to keep it. So it's a sales. Now, if that product is identifiable and it is ready to be delivered and it's on the request of the customer, I'm keeping this product just for him, then this is a legitimate sales and legitimate revenue that I can showcase because I've already sold it to the customer. The customer has requested to keep it on, not consignment, this is bill and hold. Consignment is different. Consignment, I have not sold it as until today. I have sent the goods on consignment, but that sales has not happened. So if I'm showing a consignment as sales, that's not the real sales. So that's exactly what we are saying here, that we need to bifurcate as to what is the actual sales versus which is not the sale. So consignment is definitely not the sale because I'm just sent the goods on consignment to my third party. The third party has not sold it. So if he has not sold it, it may come back. So that's one revenue. Any questions? I think a few are having, I mean, if everyone is having problem, then let me know. But other than that, I think it's at the individual end if voice is breaking. Absolutely. Karthik, you are correct. Consignment is basically a principal and agent relation. So the agent has not yet sold. So if I've sent something to consignment, I cannot say that it's my revenue. If I'm showing that, then I'm going against the accounting standards. I'm going against the regulation. So that's the difference between ethical and unethical practices, which as an accountant, I need to ensure that I'm bifurcating. If something is prepaid, then it has to go into the prepaid in the balance sheet. It cannot be said it's a revenue. So similarly, if it's a sales for next month, then I cannot put it into this month. Now, I will give you another example. I have a customer with whom I have confided. There is a lot of lag or buffer going on. Is everyone facing this, or only few individuals are facing this? Or everyone are facing this, is it? Ah. So give me a minute. Give me a minute. Let me see if something can be done. All right, I'm back. I'm just try to clear the net waves so that it comes directly and it doesn't break. And I think few are saying that it's good. So even if you are saying it's good, means it should be good. I think if you could, individuals are not able to hear me, or there is a lag, if you could just check at your end. All right, I will continue now. So that I will give you an example now, and I need everyone. It's perfect, right? All right. I will give you one example. So for example, just give me one minute. I'll open an Excel file. You're all able to see Excel file, right? All right. So when I'm doing a sales, what would be a journal entry? Anyone? Say credit sales. Anyone journal entry for credit sales? Cash to sales, yeah. I mean, I said credit sales, not cash sales. But anyone else? Would you like to change that? Debtor account to sale account, absolutely. Debtors to sale. I will make it accounts receivable, debit to sales. Good. So let's say, I mean, just put hypothetical numbers 100, and together with the sales, the inventory is going to go out. So which will add to the cost of goods sold. Everyone with me? Inventory, maybe it's 95. So the cost of goods sold 95 and sales is 100. So basically I'm earning 5 rupees in this hypothetical example. Now, for example, if I've confided with my customer wants a product from me in January. He doesn't want it in December. But because my year end is 31st December, I want to inflate my sales. So I am recording this entry: accounts receivable debit and sales credit, COGS and inventory credit. Now, can someone, the product has not gone out. How can an accountant or an auditor catch this kind of error where the sales has been inflated? Any try, anyone? Inventory, yeah. Can you elaborate on inventory? Aging schedule, yes. But can you a little bit elaborate on that inventory? Akshay, I think you're right, but stock audit, yeah. Inventory reconciliation, absolutely. So my inventory has gone by 95 in the books, but when I go on 31st December, when the auditor actually does inventory stock taking and then reconciles it with the book, he will find inventory to be inflated by 95. He will find additional product of 95, which he needs to question. So this is the typical type of either a honest error or a ways wherein someone looks to inflate their revenues. And this is an unethical part of revenue. So when we say earnings management, we talk about earnings management, which is companies cannot have AR increasing over a period of time. Absolutely, it's a concern. It's a concern. Managing revenues or managing the earnings within the accounting standard, within the regulation, is absolutely fine. Like the examples we spoke about. But if we are trying to increase the revenue without actually earning it, I've not given the service, I've not sold the product is still with me, The collectability is not probable. The customer in January may just say that, no, I don't want this product. He's at his right to say that. So I have not really earned the sales. So that's what is absolutely unethical, and it cannot be used. So that's what earnings management is all about. The reasons why the companies engage in earnings management, because they want to showcase it big for their investors. And we spoke about what are ethical and unethical. Any other inputs anyone wants to add on? So we spoke about revenue recognition manipulation. There are expense timing adjustments as well. Can you give examples of expense where so you have revenue minus expense is your profit. So if I want to showcase bigger revenue, so what can be done with expenses? What are the techniques wherein I can reduce my expenses, which deferred revenue expenditure? Okay. Depreciation, that's a absolutely correct point. So let's take the depreciation point. I have bought a machinery. Now I am estimating that this machinery may have a life of 7 years. Some other company, same machinery, may say, okay, this machinery may have life of 4 years. So individual companies are at their own to estimate a life. So there is no accounting standards which says that, okay, the machinery has to be 6 years. So it's up to the business foresight. You can estimate it whether it is 7 years or you think it is 4 years. But what is more important is consistency, right? So today, if I'm saying that this machinery has a life of 7 years, and I will depreciate it divided by 7 straight line method over the period of 7 years. But tomorrow I can't come and say, oh no, it's 4 years. Why? Or I can't say today it's 7 years and next year it becomes 10 years. I need to be consistent. All with me? Why I need to be consistent? Today I'm saying 7 years. Tomorrow, next year, I want to show up revenue even more because I want to show a trend. So this year I won 100, next year I won 120. So I'm doing better. So I want to showcase that good picture. So what I do, I will change my life of the asset from 7 years to 10 years. So what happens is my depreciation amount goes down and my net profit increases. You with me? Yes. Is this allowed? Can I do this? Can I change the life of asset? So this year I'm saying it's 7 years. Next year when I'm preparing the financial, I'm saying it's 10 years. Can I change it? No, 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 no. Lot of no's. Yes, you can. Iman is saying yes, you can. Investor will be out of company stock. Okay. Maybe not. All right. Now look into this. To this year I'm saying life of asset is 10. Or let's take this example. Today I'm saying the life of asset is 5 years. Next year there's a new technology in the competition, because of which I feel that it's not 5 years. I think at the most I can sustain 3 years, and then I will have to change the machinery because there's a new technology there. If I don't use the technology, my competitor will use. He will take away my customers, right? Prospectively, we can change it. That's the main point here is that if I have a legit reason why I need to change the life of asset. For example, I'm saying this year 5 years, next year there's a new technology come in. I feel no, it is only 3 years. So I have a legitimate reason to change the life of the asset. Then I can change it. However, there has to be a transparency. So first we spoke about consistency. Now, second thing is transparency. And how I can be transparent? How can I be transparent? Next year, when I change the life of asset and the depreciation method, how can I be transparent? Anyone? Notes and financial statement. Absolutely. Bingo, Harsha. Great. You're genius. So you need to disclose it. So you can't just change the life of asset and issue the financial statements. You need to disclose it. So consistency and transparency. If you change it, you need to be transparent with the reason in the footnotes. So you have income statement, you have balance sheet, you have cash flow statement, and you have a lot of footnotes. And in those footnotes, you need to disclose to the investor. The investor needs to know that the depreciation amount has reduced or it has increased as compared to last year because of change in life, and that's why there's a change in revenues. The investor needs to know. The lender also needs to know. When he lends the money, he looks at the financial statements, so he needs to know, he needs to read that footnote as to why there is a change. Now let's relate this part from income statement to balance sheet. What happens when there is a change in depreciation? Now today I'm saying it's 5 years, tomorrow I'm saying it's 3 years. My asset or my PP&E, the that is valued at cost less provision for depreciation. So the valuation will change in balance sheet. Yeah. So will the change in depreciation result in change of valuation in balance sheet? That's the relation. So these are the no, why no, Harsha? Any reason? If our depreciation is changing, if I'm changing, we show it at historical cost. You are correct. But don't we show it at historical cost minus provision for depreciation in your balance sheet? So if the historical cost is 10,000 and your life of asset is 4, so you are incurring a depreciation of 2,500 every year. So at the end of the first year, you will show 10,000 minus 2,500, 7,500. Harsha, you are with me? Correct. Accumulated depreciation. You're right. We will decrease it to arrive at the fixed asset. So every PP&E in the balance sheet is valued at historical cost. You're right. That's how it's presented, minus accumulated depreciation. So if you're changing the life of asset, if your depreciation is changing, then your valuation in the balance sheet will also change. So it will have a direct impact in the balance sheet. You're with me? Everyone? And this is where we need a framework. We have a regulatory framework, which is called as GAAP in US. In US, we call it US GAAP. In India, we have India GAAP. In UK, we have IFRS. That is the International Financial Statement Standards, reporting standards. And as I said, there are standards which everyone have to adhere. Estimates, the business is free to estimate as per their vision. Estimates can differ from A person to B person, absolutely fine. But whenever there's a change in estimate, it has to be disclosed. That's what the framework says. That's what we need to understand as an accountant as to what is the accounting standard and is the financial statement adhering to these accounting standards. Because on the basis of these financial statements, investors may invest in this company, lenders may lend money. If the financial statements is not prepared as per the accounting standards, then that number is not reliable. You all with me on this? Any questions so far? Now let's look at effects on income statement. There's something called an income smoothing. Yeah, accounting standard 16 for depreciation. That's right. Income smoothing will speak about income smoothing, earnings, quality variations, and implications for investors. Income smoothing, just by English word, any guess? I mean, that's how I love to learn. I mean, I first like to guess from the English word meaning and then deep dive it. So just, I mean, you might not have heard this, but by income smoothing, what do you feel it could be? Regression analysis, okay. Removing small imperfection, little bit close. Yeah, yeah. Smuggling, okay. So, I mean, it's given that, so basically there could be a volatility or seasonal fluctuations, price fluctuations, or there could be seasonal fluctuations. In certain months, the sales could be big. In some months, the sales could be small. So within a year, you can the business can just plan out their expenses in a way that it matches the revenue. In the sense, for example, if the April month is a high sales, high revenue month, the business usually earns a big revenue in the month of April. So what the business can do or can plan is it can try to spend some future expenses in April and show it against the revenue, so that in the low months you have low expenses because you've already spent it in the month of April. So say in the month of May and June, the revenues, or by season, it's a low season month. May and June is a low season month. April is a big season month. So when you have a bigger revenue in the month of April, you try to incur some future expenses for May and June in April itself, so that when the month of May and June comes, because the revenue is small, your expenses will be small, and that's how you try to bring a trend. Make sense? So it is an intentional evening out the fluctuations in earnings over time, so that you show more stable and predictable financial performance. So let me ask you one question. If you're investing in a company, would you prefer stable earnings or volatile earnings, and why? Stable earnings. Most of you want to put your money in a company which is stable and not volatile. Stable with growth, yeah. But there's a trend of growth. So we can focus its earning and can focus easily. Yeah, absolutely. So as an investor or as a lender, you don't want to show, you don't want to see a big spikes, because spike means there will be a question mark whether this is sustainable or not. So from the business point of view, they try to maintain this trend so that you're able to present it a very stable trend going forward. And this is within your accounting standards. This is within regulations. You're not booking revenues before you're actually earned. No, you're not doing that. That's unethical part. But what you're doing is you've already earned revenue. You're trying to incur an expense of future in advance, so that you can match it off with a bigger revenue. And in the future months, when the revenue is low, your expense is also low. So overall, your trend looks very stable. You with me on that? So with the objectives of income, as it reduces the perception of risk, it meets the earnings expectations, it avoids all the regulatory scrutiny, because when there's more violation, regulators come into picture as well. So sometimes you defer a revenue to a future period so that you don't um, you can avoid spikes. So you're deferring a revenue. The opposite is unethical. So if you have not earned revenue, showing a revenue, that's unethical. But you've already earned it and you're deferring it to avoid a spike within a financial year, then it's absolutely ethical and within the accounting standards. or you're recognizing future expenses early, as I said, or even in case of depreciation in a particular month, if you if the revenues is more, you can go into a double declining mode rather than a straight line. Or you can also have a higher reserves for doubtful debts and warranties. So these are multiple examples or multiple ways or techniques how income smoothing can happen so that there's a very even trend. Prepaid expenses are another one. Deferring revenue, yes. So you have already earned the revenue in April, but you defer it for May and June, because in May and June, you know, the sales is low. So to show a stable revenue, you do it. You've already earned the revenue. There's nothing wrong in it because it's within the financial year. It, if I had to give a parallel example, I don't know how many of you are conversant with the income tax. Usually what happens is from 1st April to 31st March, the whatever income you have earned, you need to report it. And there's a provision called ADC in income tax India. It's all, although it's phasing out. So what people do is, I mean, they're supposed to invest in a particular investment throughout the year, but they all, you know, come up alive only in the last month, and there's a lot of rush, and they do the investment in March. But that investment that they do in March, they take the deduction for the entire year. So if the income is say 5 lakhs, and under ADC section, you can invest up to 1,50,000. You invested all entire 1,50,000 in the month of March. Then, but you can show that as your investment for the entire year. So that's how the same concept goes with revenues as well. So it's like you can defer your revenue or you can prepone your expenses so that you can show the same trend. Earnings quality variation, again, just by the words, what do you understand by earnings quality variation? So we have already spoken about the reliability and sustainability of the financial statements. So for example, let me directly give you an example. If two companies have a net income of $500 million each, okay, one company is driven through its core product sales, its main operating business and consistent growth. It has a net income of $500 million. Whereas the company B, it also has a net income of $500 million, but it's not entirely through its business. It has sold an asset. Let me give this as an example within a screen. All right, you can all see my screen, right? So company A, for example, has a net income, and company B also has net income of 500. But this has come from its core operating business. But here, this is from operating business, plus it has a sale of asset, for example. So which one you would say is a high quality earnings and which one you say is a low quality earnings? Low quality in the earnings in the sense from forecasting for future. Which one is more sustainable? Company A or company B? Company A has earned. You got that, right? So even if both the companies are reporting a net profit of 500, from an investor point of view, from a lender point of view, very important to see from where is it coming? Is it coming from the main core business, or is it coming from the sale of asset, which could be a one time? It may not be sustainable, right? So everyone are getting this, right? So that's what. So this is more of a high. This is called as more of a high quality earnings, and this is called more of a low quality. low quality means from the future perspective, which is more sustainable. So this is sustainable, whereas this is not so sustainable. Only the part of business is sustainable. And we spoke about implications for investors. Investors rely on financial statements. So any change in income raises a question in investors' mind. I mean, if you invest in a company and you see a financial statement, it will raise a question mark as to why a profit has spiked or why it has gone down. Yes. Now, just take a scenario wherein the numbers in financial statements is not reliable. What will be the implications for investors? So if I'm as an accountant, I've not followed the accounting standards. I have considered revenue even before earning it. What would be the implication for investor? Would it be reliable? Would the financial statements be reliable? I'm showing the profit is going up. Great. The investor is investing. He's excited. Suddenly tomorrow he will come to know the reality and the share market will just go down. Absolutely, absolutely. That's misrepresentation. Absolutely. You're right. You're right. So you're able to make sense of the relation from the income statement to balance sheet and the financial statement to investors and lenders. So we'll talk a little bit more on effects on balance sheets. Example in this in bank. Yeah, I'm going to talk about that in this in bank little later when we talk about valuations. So yeah, Harsha, that's a good example. That's where the accounting for hedging went wrong. I'll speak about hedging in little detail in a while. It's 1,500 CR, I think. All right. So asset inflation and write downs. I'll go just one by one. PP&E we already spoke about. It's always valued at cost minus your accumulated depreciation. Investment. How is investment valued in balance sheet? Is it at cost or market value? Question, investments. Investments in shares, investment in other companies. Now, investment could be shares or it could be debentures or it could be debt as well. So it's valued. How is it valued? Is it valued at historical cost or at fair value? Fair value. Absolutely. Uh, if uh, if the investment is on equity shares, then it is fair value. If the investment is on debt, then you need to bifurcate between whether it's a short-term debt or long-term debt. If it is a short-term debt within 1 year, for example, which will show in current assets, then it is fair value. But if a debt is to be held till maturity, say for 10 years, and if that debt was issued in a premium or discount, then the valuation is not based on fair value, it is based on historical cost plus minus amortization of that premium or discount. This is only in case of debt. If I'm investing money or I'm lending money or any debt fund, for example, you need to bifurcate between whether it's a short term or long term. If short term, then yes, fair value. But in case of long term, then in case the intention is to hold that debt security till maturity, the maturity may be 10 years from now, then you amortize the premium or the discount part, and you show it in the historical cost. Rest current asset, current liability is the way it is. Options, futures contract, anything short term. It's all short term. It's all mark to market. It's all fair value. Bonds are impacted by changes in interest rate. Yes, the bond price will may increase or decrease as per the interest rate increases or decreases. But again, it's the same principle, Varun. If that bond, if the intent of investing in that bond is short term, then you will value it as per the market price, and the market price will change as per the interest rate. So you're right. But as a bond, you're investing for 10 years, because when you're investing, say you have invested it at 8%, you are getting 8% every year and you are going to hold it till maturity. Then the market price does not impact. Market price impact only if you will not hold it till maturity and you will sell it in 2 years or 3 years. So accordingly, you will have to adjust your valuation. You with me on that? Option, future, or off balance sheet financing. To start with, futures, no, it will be off balance sheet, but any change in the value of that futures, whether it's a gain or it's a loss, it needs to be accounted for. In case of options, I mean, Varun, you pay that premium upfront, so that premium you need to expense it out, or you need to amortize it over the period of that option. All right. The same goes with the cash flow consideration. Now, in case of premium is basically a sunk cost. Yeah, it's a sunk cost because it's an expense. Basically, it's an expense. In case of cash flow, the opportunity of any unethical changes is very low, because cash flow is like cash. It's actual cash going out. Is actual cash coming in. So from the bank, it's going out, from the bank, it's coming in. So there's not much of an opportunity to inflate it. However, from the presentation point of view, a cash flow, an operating cash flow versus a financing cash flow needs to be classified. Now, for example, if cash flow are like Bible for any company, yeah, since it ignores accrual, because it's the actual cash going out and actual cash coming in. But what we need to be cognizant of, or we need to pay attention, is whether that cash flow is an operating or a financing. So if I've issued equity shares and if I've increased the capital, for example, and at a premium, that premium cannot be used to pay dividend. That premium cannot be shown as my revenue. So it has to be classified as financing. It cannot be classified as operating. So it's very important that the cash flows are shown correctly as to whether it's an operating or whether it's a financing, or it is a capex. Capex in the sense you have invested it. So if you have invested it, you cannot expense out completely and show it as operating. Just because you want to increase your revenue. So that's not permissible without the accounting standard. Cash flow is prepared, net change in cash during the year. You're correct, but at the same time, the classification is very important. As to net change in operating cash, how much, net change in financing, how much, is it negative in financing, is it negative in operating? That's important part, Varun. All right, we will get into. Yes, true bifurcations is essential. Absolutely. Because why it's essential? Because you don't want to show the financing part as revenues. I mean, you take a loan and pay out dividend to investor. That's unethical, because dividends can be paid out only out of operating profit. All right, so we have spoken a lot on revenues, expenses, income statement. Let's get a little bit on valuations and earnings management. Now, when it comes to valuation, you may have a lot of assets, right? You may have gold, you may have real estate investment and equity shares. Now, when it comes to gold, do you know what's the price of gold today? 24 karat, 1 gram gold. Do you know the price? Absolutely. Bingo. That's where. So why do you know it on the top of your mind? Because you just can Google it. Why? Because the gold price is regulated. It is listed. So it's very easy to value gold. So if I have a 50-gram gold, I know that 1 gram cost 9,200, multiply it by 50, and that's the value of the gold that I have. Now, real estate, let's move to real estate. I have a 2 BHK apartment. Do I know exactly what is the value of my 2 BHK apartment? Yes, yes, but do you know exactly, or you have an estimate? In case of gold, you know exactly 9,200. But in case of real estate, do you know exact? No, it's very subjective. That's right. It's very subjective. So I have a 2 BHK here. I see, okay, that 2 BHK which is facing the road sold at 1.5 CR. The other 2 BHK which is facing the garden is 1.75 CR. My has partial road and partial garden, so it may be somewhere in between. So that's how you estimate the value of the asset. Now let's get into the company. In case of equity shares, I have invested in an equity share which has listed, for example, say Reliance Industries. Do I know the value of that investment in equity shares in Reliance Industries? Yes. Everyone, yes. Very simple. It's listed in Bombay Stock Exchange, National Stock Exchange. I just go there. I know that, okay, the Reliance per share rate is around 1400. Very easy. Now, if I've invested money in an unlisted business, which is not listed, but I've invested in my friend's business, friend's company, private equity, absolutely, that's the right word. Would I get the ready-made value of my investment? No, right? Everyone with me? Absolutely not. So in that case, what should be my valuation? So my valuation is more or less the money that I've invested plus minus any observable change. You need to have public comparables. You have these are observational change. So I have invested, say, 1 lakh. Some observation changes as per the public comparables. All right. Similarly, there is a long list of methods as to how we can arrive at valuation. Now, let's talk about few valuation that I have here on my screen share, a discounted cash flow. Now, I don't have any observable changes here and there. Public compare, I think Varun is saying, I don't have anything to compare around as far as the business that I have invested. But I know what would be my estimated future cash flow each year for next 5 years and beyond. So the discounted cash flow, anyone, just by words again, it's absolutely fine to go wrong. Absolutely fine. That's how we learn. So just by discounted cash flow, what do you mean by discounted cash flow? Using present value, present value of the future cash flows. So let me make an example here. So for example, we'll just make few examples and then I'll explain. So say, and now these are all estimates, future estimates. I'm forecasting my cash flows. So say my forecast in year 1 could be around 60,000. Second year could be around 80. I'm just putting hypothetical numbers. What I mean here is, at the end of the year 1, I will get 60,000. At the end of year 2, I will get a revenue of 80,000, and so on and so forth. Now, what's the present value? Because I need to arrive at valuation of this business. which will get me these cash flows over the next 5 years. Now this is basically a formula for discounted cash flow. If you could understand just looking at this, then fine. But usually when I see these kind of formulas, I just run away. It's quite complicated, but I'll make it very simple as to this exactly how we can dissect it. So say the weighted average cost of capital is around 10%. Okay, the weighted average cost is around 10%. What that means is, if you understand what's the present value, right? If I have to invest 1,100,000 in fixed deposit today, then 1 year from now, assuming 10% interest rate, it will be 110,000, right? So that's the value. So whatever is 110,000 after 1 year, today it is 100,000. Why? Because of inflation or because of devaluation of money. So that's why we need present value of these future cash flows. So all we need to do is I'll round it off. So divided by 1.1, why? Because what will be 1.1 year after? Today it is that much less. So if I have to do a 10% here of this, it will come back to 60,000. So what it means is if I've invested 54,545 today at interest rate of 10%, a year after I will get an interest of 5,455 and it becomes 60,000. So that's why the present value is 54,545. All with me? So similarly, in the year 2, is the same raised to 2, 3 raised to 3, 4, because just goes back and back. For 5 years, if I have to get 1,60,000 after year 5, what's the present value today? That is also a formula in Excel which you can use, but basically I needed you to understand the concept. So divided by 110% is what you do. And I'll just sum this off. Sorry. Suppose. All right. So the present value of the cash flows for the next 5 years today is 398,275. Now, will my business end over here? No, right? Usually in the first 5 years is very challenging because you have to stabilize it. Your revenues will go on increasing it if you are doing in the right way. But this will not stop over here. You're right. The PV of TV plus PV of CF. So if after the fifth year, I am anticipating that this will increase by say 3%. So the the cash flow at the end of year 5 of 1,60,000, I am expecting, this is my estimate. This is all those valuation is mostly through estimates, is 103%. Divided by the weighted average cost of capital is 10%, which is like a normal interest rate, minus this 3%, which comes to 0.07. So that's 54286. Now this is after 5 years, from 5 years beyond. So what is today's value? Again, I do the same thing, divide by 1.1 by 5. So this is my valuation of this business as per the cash flow method. That's right. This is the enterprise value. Add this value to it and you get the overall valuation. Everyone with me? when it comes to cash flow. So it's like, for example, in the step one, you plant a tree. In the first year or second year, you may not get so many fruits. It may take 5 years to really, get the maximum. But after 5 years, it will stabilize. So it will increase in first 5 years, or 3 years, or 7 years. I mean, depending upon different business, the number of years could be different. And we have the estimation, and later on we expect that okay, it will increase by 3%. So divided by the 7%, that's 10 minus 3, and the present value of that amount, that gives you the total valuation. So with me, everyone? Everyone following, or do you need me to explain this again? The cash flow part. So basically, it is like estimating or forecasting what would be my cash flow for future and getting the present value. That's about it. That's what all this complicated looking formula is doing. Price to earnings ratio. This is very, very popular in stock market. I mean, most of the investors today, they know what's PE ratio. What is PE ratio? So, for example, this is and very easy to understand as well as to what is price to earning ratio. For example, I have a share of company A. The market price is say 1,000. I'm just making it up. 1,274. The earnings, the net profit, as per income statement, say is 114. So the price to earnings is 11 times. That's about it. You compare the valuation of your peers and accordingly value your company. Absolutely. So if you know the earnings, for example, and you're looking at your peers, you know that the P ratio is 11 times. Then the valuation straight away is your earnings multiplied by that many times. That's your value. That's the other way of looking at it. Straightforward as far as price to earnings ratio goes. Everyone with me? Yes, you're right. 11 rupees. Great, great. Others, are you able to follow? Others, if you could just put, I think, nice. And the other valuation is, for example, you don't know what is your cash flow. You don't have those numbers. Then the other way to do is through EBITDA comparison. What is EBITDA? Accounting world. Anyone? What is EBITDA? Yes, yes. Earnings before interest. So you don't know what would be your cash flows, but you know what is your earnings before why before depreciation and amortization, because depreciation and amortization basically is not cash flow. When you buy a machinery, at that time there's an outflow, but later on it's just a book entry. So that's why you look at earnings before interest and tax, because you need the real cash flow. With me on that? So now what you do is, for example, you have from this, you need to reduce the tax. And then you need to see how much is your capital expenditure, capex, and how much is your change in working capital, WC. That will give you cash flow, the real cash flow. So for example, if this is 800, sorry, 700 or whichever number, tax is at 25%. Although usually the tax is calculated after depreciation, amortization, etc. But you're right, for tax purpose only. So Varun, to calculate the tax, you need to deduct depreciation, amortization, and then you need to calculate tax and put it over here. But here, just for ease purpose, I'm directly calculating it over here. Let's assume that the capital expenditure every year could be around 50, and the change in working capital could be around 25. So my cash flow would be minus tax, minus capex, and minus this. So it's 450. That's my cash flow. Rest all the same. Take the present value, total it up for year 1, year 2, year 3, year 4, and then get the valuation. Rest all remains the same. You all with me? So this could be year 1, for example. Then it could be year 2. So that's how you can value if you have earnings number. And can do this. So your cash flow in year 2 is so and so. And then after 5 years again, you can use a multiplier. Here we are using a percentage of 3%, increasing 3% after the 5 years. But you can also use a multiplier. What does multiplier mean? Multiplier is like, for example, I'll come back to the example of rent. My annual rent is say 1,80,000, and I know that is the rent dependent on the value of the apartment? Does the rent have any relation to the value of the apartment? If I'm reading, yes, you're right. So if the average rent in my area is around 2.5%, for example. So if this is 2.5%, can I say that my apartment is of 72 lakhs or 7.2 million? Everyone? Yes? Can I say that? So what does this mean? Is my value of my asset is 40 times the income. So the multiplier here is 40. You all able to understand this? So my cash flow, if it's year 5, is 160. Instead of saying it is going to increase by 3%, if the multiplier is, for example, 8, then I do multiplied by 8 and then I take a present value. So there's a lot of different ways of valuation, of arriving at a valuation of an asset based on what numbers I have. Do I have cash flow numbers? Can I estimate earnings? Can I come up with a multiplier, or can I estimate how much percentage it's going to increase after year 5? So based on that, the valuation is arrived at for each asset. You're with me on this? Everyone able to follow? If everyone can give me a thumbs up, if you're able to follow or say yes. We spoke about valuation. Now we spoke about cash flows. We spoke about income statement, the trends. and I think we have briefly discussed this as well. The entire valuation is dependent on financial statements. Because it needs a history, right? You will look at history and then you will estimate or forecast the future. If the financial statement itself is incorrect, then your valuation will also go wrong. Everyone with me on that? So how do you identify red flags in financial statement? Very important for an accountant or for an auditor as to, I mean, every red flag may not be fraud. Sometimes it can be errors. Sometimes it can be oversight. So it's very important to understand the red flags in financial statements. So what could be the red flags? In what, I mean, if anyone can provide any inputs. I think we already spoke about few. A very unusual revenue growth. Is that a wrong? Wrong valuation is a outcome of incorrect financial statement. Wrong valuation, overvaluation, undervaluation, that's an outcome. But I'm coming back to the baseline. Financial statements. I'm talking about financial statement. Financial statement is like a postmortem. It's not a focus or valuation. High provision on year end, that's right. Incorrect provision on year end. Unusual revenue growth. So suddenly you see a spike in revenue. There will be question marks. Large other income. What is this other income? I mean, if it's an operating income, understand, but what's this other income? If the receivables are rising very fast or inventory is building up very fast, the inventory to sales ratio is rising. So all these ratios, if the goodwill or intangible has increased, they need to be questioned. If the net income is much greater than the cash of operations, for example, your net income is say 1 million, but the overall cash inflows from operating is much less than that. What does that indicate? That indicates that all the profit may not be real cash, so it needs to be investigated. That's a red flag. If there's a negative cash flow, that's a red flag. If there are frequent financing inflows, equity every year, so that means that company is not able to sustain. High interest expenses, yeah. So if interest expense today is 0.5 million, tomorrow it becomes 1.5 million. Why? Is it because of increase in debt or something else? So that's a red flag. You're right. I think Harsha, you're asking earnings before interest and tax. Then you need to EBIT is after depreciation and amortization. So you have EBITDA, that is EBITDA, that is earning before interest, tax, depreciation, amortization. Then you reduce your depreciation and amortization, you get EBIT, that is earnings before interest and tax. Then you reduce the tax portion and the interest portion, then you get the net profit. You got that flow, Arshan? Too much of account receivable would also be a red flag. For example, if the payment term is 30 days, I expect that my customer will pay me within 30 days. But I see that the aging of the account receivable is 60 days. So for 60 days, customers are not paid. That means there's a red flag. Is it a fictitious account receivable? Did the sales actually happen? Because then if sales actually happen, then why is the customer not paying? So that's a red flag, Varun, you're right. Depreciation not charged properly. I mean, yeah, we spoke about it. That could be a red flag. If I've changed the life of the asset and I've not disclosed it, that's a red flag. Harsha, are you fine with your question as far as EBIT minus tax plus, you're right, in a way you're right. Minus capex minus employees are free cash flow. So you all got the gist of what the income statement is, what the balance sheet is, what the relationship. I mean, that's I mean, we'll not deep dive into too deep in this because it's just to give in this master class, the objective was to give a high level gist of the earnings and its impact to the valuation. So if I had to, Harsha, if I had to show it on the Excel, just give me a minute. So you have EBITDA, then you reduce depreciation, then you reduce amortization, you will get EBIT, right? Then you reduce interest or add interest and reduce tax. You'll get net profit. You're with me? So to this net profit, what you need to do is add back interest, depreciation and amortization, plus interest, plus depreciation, plus amort. And then you reduce capex and plus minus change in working capital. That will give you cash flow. You with me on that? Any questions so far? We spoke about the historical earnings and the past incidents. I will quickly, we also spoke about ethics, non-ethics, the role of corporate governance and the transparency that is required. Future trends in earnings, technological influence. So I'll give you an example of the Indus in the bank, which happened. I think someone did ping me in the chat about Indus. There was a hedging. Yeah, that's an indirect method of cash flow. You're right. I mean, there are different way of calculating cash flow. You can either calculate in calculating EBITDA and minus tax and this, or you can go from net profit. So in case of hedging of cash flow, where there was two departments, a liability department and then there's a derivative department. In case of liability department, they recorded the liability for a foreign currency. In foreign currency, for example, if I'm in India and I need to pay my loan or debt after 3 years of $1,000. So today's exchange rate versus 3 years later, that exchange rate difference may be huge. That can be either I can gain or I can lose. So to hedge that risk, I go into futures market and buy that foreign exchange or buy the futures of the foreign exchange. Now, gain in one in the futures contract will be a loss in my liability, right? Because the foreign exchange, which is say 85 rupees per dollar, has become 82 rupees per dollar. So in that case, I'm gaining in my liability. Now I have to pay only 82 rupees as compared to 85 earlier. So I'm gaining it. In futures contract, I'm doing exactly opposite. So I'm losing it there. So I need to ensure that I'm recording gain here and recording loss there. Or in another way, if the rupee has depreciated, the 85 has become 87 or 88, for example. Now I have to pay more. So instead of 85 per dollar, now I have to pay 88. So that's a loss in the liability side. And it's a profit in my futures contract. So now what happened in the IndusInd Bank example, where there was a issue of 1500 or the profit and loss were understated by 1500 crores, was that while the derivatives department did account for those FX gain loss by MTM, mark to market. The liability side did not. So in one side there was a gain, and one side the loss was not accounted for. So my revenues for so many years, for year one, year two, year three, was all overstated. At the end, when I had to actually make the payment, there was a huge loss, because the gains was recorded on one side, but the loss was not recorded on the other side. And that's where technology can play a part, where there can be linkages between two departments. So when one derivatives department is recording some FX futures, it can link it to this liability. If it links it to this liability, there can be an exception report, or there can be an auto adjustment of a gain. So that's what technology makes things easier for governance point of view, or even from efficiency point of view, or even from reliability of the financial statements point of view. Same goes with AI, a big data, because a lot of data is being analyzed. So we spoke about red flags. So there can be an auto exception report, which will straight away show us where the red flag is and where we need to concentrate our work, and as an accountant, where I need to look into and what correction needs to be done. So these are all evolving. The technologies are evolving. The job is getting better and better, and so is the regulation. So it's very important for an accountant also to keep himself up to the changes in the regulation, whether it's a gap, India gap, US gap, as the case may be, as that. So that's where the future trends in earning management is heading to. Any questions? And these are the skills that would be required. Very important that you network, you talk to people, talk to the seniors, talk to the students, talk to the people who are working in different industries. Network is absolutely necessary from professional development point of view. Ethical, absolutely stick to ethics, and analytical skills is more and more it's what required for having a career in finance. You need to understand obviously the basics, from the golden rules, debit, credit, etc., to the financial statements, to adherence to the regulations, and then the technology, and to analyze where the trend is going. So these are the basic skills that one needs to build on as one's career progresses. Any questions, anyone, as we come to the end of the presentation? Hope you all at least learned few things over the last 1.5 hour on earnings and its impact on the valuation. And I think, yes, everyone, it's a Saturday evening. I will not keep you held for too long. So thanks everyone for your time, and hopefully we will connect again. Wish you all the best in your career. And if there's any guidance required, do reach out to me. I'm always there. Thank you very much. Have a nice weekend.